Greetings, my beloved clients. I was thinking about you this morning on my hike and wanted to share a thought with you on winning, and specifically the nature of winning. So by the way, if you can see, I'm wearing my Berkshire Hathaway shirt from the 2019 annual meeting of Berkshire Hathaway and the 5K run I did there at the meeting. There's a caricature of Warren Buffett and Charlie Munger. Anyways, so let's talk about winning. And we're going to talk about winning in general and winning specifically in the stock market. And when we talk about winning in the stock market, what I mean is beating the market, or specifically beating the S&P. And quite frankly, there are very few winners. There are very few managers that are able to consistently beat the market over time, less than 10%. And fortunately, we're in that group. Over the last 1, 3, 5 years and year to date, we're beating the market. Okay, so what does it take to win, and what does winning feel like? What does winning look like? Because as you may know, this week is kind of a turbulent week in the market, and you may not feel like you're winning. So let's talk about winning. So let me tell you a story. So I started in this business in 1991 after I graduated from college. And the 90s were a great decade for investing in the stock market. It practically went straight up. I mean, there were some hiccups to start the decade with the S&L scandal in 1990, 91. In 94, Greenspan raised rates like 4 times, and maybe 6 times in a row. And it gave the market some pause. And in 98, we had the Asian contagion. There was also a crisis in Russia, and the long-term capital big hedge fund blew up, and it rocked the market for a little bit. But all in all, the decade of the 90s was phenomenal for investors in the stock market. And investing in the stock market became increasingly popular because the market was averaging like around 15% a year over that period. Some top managers were managing, 20% a year or more. And so many investors got into the market, and the vehicle of choice for many of those investors was the mutual fund, which was great because with one fund, with one transaction, you had broad diversification and professional management, and that suited many people very well. But there were some drawbacks to the mutual fund. One was this thing called embedded gains. So particular within a fund that had been very successful, they may have had some positions in their portfolio that they owned for a long time and had huge gains in that position. Let's say they bought Microsoft years ago and they were up 2,000% on that one position, and it contributed greatly to their total return. Well, but what if they were ever to sell that position? Well, if they were to sell that position, they would distribute those capital gains evenly to everyone that was a holder of the fund at that time. Whether you had gotten into the fund 10 years ago and participated in the rise of that fund, including the rise of Microsoft, or whether you had got in a month ago and really didn't see any gains, or a small gain, or even a small loss, you had to pay capital gains as well. So that was a problem with embedded gains. There was another problem because of the pooled nature of the investment, was that, let's say the market had a little bit of turbulence and some investors got jittery and wanted to sell. Well, so the fund manager would receive these redemption notifications and he'd have to sell. Whether he wanted to or not, he had to sell to raise cash to pay these people off. And let's say you're one of the investors in this fund and you're a level-headed investor And you're saying, no, right now is not the time to sell. Everything's down, it's the time to buy. And even the manager, let's say he's brilliant, he knows it too. Right now is not the time to sell, it's the time to buy. But his hands were tied. He had to sell because some people in the boat wanted off. So that hurt the manager, that hurt the people that stayed in, but that was the nature of a mutual fund. And it worked on the way up too. So let's say that the fund had a great year the last year. So new money comes in, seeing his returns. And maybe he's not really wanting to buy. Maybe he thinks, stocks are fully valued or overvalued. But because new money came in, he had to buy. And maybe you're a level-headed investor. You're like, no, don't buy right now. It's too high. Well, there's nothing you could do. That's just the nature of mutual funds. So over the course of time, Wall Street came up with a solution to those problems in the mutual fund, and it was called a separately managed account, or SMA. So with a separately managed account, you gave your money to that same mutual fund manager, right? But he opened a separate account just for you. And so when he bought stocks for you, they were at your cost basis. It wasn't anybody else's cost basis. And just because someone else wanted to sell, it didn't impact your account because your account was separate. Okay, so it solved a lot of those problems of a mutual fund. Now, when it first came out, it was only for people with over $250,000 to invest in, compared to mutual fund, which is usually like $1,000 to invest. So, but because the advantages of that, and for my top clients, I said, let's move into this separately managed account to avoid those other problems. And there was an interesting side benefit to investing in the separately managed account, and that was on your statement. So let's say you had 3 mutual funds. So you had the Fidelity Growth Fund, Fidelity Value, and Fidelity International Fund. So when you got your statement every month, you'd have 3 lines on your statement for those 3 funds, and you saw how they did, right? Well, when you had a separately managed account, you might have had those 3 funds because your account was separate. You saw every position in each one of those separately managed accounts. So instead of 3 lines on your statement, you might have 200 lines because each fund had 50 to 100 stocks in it. And so we were able to see in real time what that top investment manager was doing on a day-to-day basis, what he was selling, what he was buying, what was in his portfolio. And it was very interesting because previously we weren't able to see that in a mutual fund. And the amazing thing, keep in mind, this was in the 90s when the market was pretty much going straight up. Market was averaging 15. This top manager was averaging 20. I mean, great manager, great performance, and a great time to be investing. And you look at those, say, 60 stocks that he was managing, and how many of them do you think were winners of those 60? This is the amazing thing. About a third. About a third of those would be winners. The other third were maybe just treading water, and maybe the other less than a third, maybe a quarter were duds. And that's what a great portfolio looked like from a great manager getting great returns in a great time in the market. And I was blown away that this guy only needs to be right a third of the time and he's able to beat the market. So that's a key point that I want to stress as far as what does winning look like. And winning doesn't mean every stock you pick has to be a winner, or even half. If you have a batting average like a great baseball player, the low 300s, you're a winner. You're one of the greats. Okay? So the way my investments are set up is similar to that separately managed account, right? Each client has his own statement, his own cost basis. I don't have to sell his account because someone else wants to get out, right? And you get to see every position I have. Well, don't be surprised if you don't have 100% winners in your portfolio, and yet we're still beating the market. That's normal. That's what winning looks like. That's what winning feels like. I mean, you look at Tom Brady. Many people would consider him the GOAT, the greatest of all time. And he didn't win every Super Bowl he played in. He didn't complete every pass he threw. You know, every time he wasn't in the red zone, he didn't get his team into the end zone. He threw some interceptions, he lost some games, and yet he's considered one of the greatest of all time. That's just the nature of winning, right? You watch any basketball game on any given night, and, you know, it could be a score of 114 to 108. And so the winner allowed the loser to score 108 points. He got scored on that many times, you know? And maybe he didn't win every single quarter. Maybe maybe he didn't sink every single shot he took, but he won. Okay? So that's the nature of winning. And that applies to investing as well. You don't have to be right every single time. You don't have to win every single day to have a winning track record. A legendary track record. I mean, I was teaching a friend to box, and he was like, man, I'm getting hit too much. So we worked on some defensive skills, and he was sparring again. He's like, I'm still getting hit. and the greatest defensive boxers of all times that put on a defensive performance at the end of the fight, they look through the statistics and like, this guy, his opponent was only able to connect on 20% of the shots. What an amazing defensive performance, right? That means the other guy was hitting him 1 out of every 5 shots he threw. And that's an amazing defensive performance. And the guy was winning, he's like, he couldn't miss. He had pinpoint accuracy. And he was connecting on over 40% of his shots. That's winning. Okay, so that means he was missing half the time. And so I just want you to get a feel for what winning feels like. So a week like this week is normal in the life of a winner. Do we hate it? Absolutely. Did Tom Brady hate losing? Of course he did. Do I want to run across the other side of the field and shake the other guy's hand? I don't. But guess what? Tomorrow I'm going to get out there and play again, because that's what winners do. And it's not for everybody. There, like I said, there are very few winners. But that's the nature of winning. I want to read a quote to you. This is from one of the greatest winners of all time. He said this. He said, I missed more than 9,000 shots in my career. I've lost almost 300 games. 26 times I've been trusted to take the game-winning shot and missed. I failed over and over and over again in my life. And that is why I succeed. Right? Winners don't quit. The amazing thing about, and that was by Michael Jordan, by the way. And the amazing thing about guys like Michael Jordan, Kobe Bryant, that impressed me was that the game would be down to the buzzer, and they'd be in the final little huddle there of the team, and he's like, Coach, give me the ball. And the coach is like, we're going to give the ball to Michael, and he's going to take the game-winning shot. And then he misses. And guess, the amazing thing to me was that these guys didn't beat themselves up or put themselves on the sideline for the next game. If in the very next game it was down to the buzzer, that winner would go to the huddle and he'd say, Coach, give it to me. And the coach would say, we're giving it to Michael, because they know who the winner was. And that's what we do. If we took a defeat in the arena tomorrow, we're going to get back in there, and we're going to learn from our mistakes. We're going to try harder. We're going to read more, and we're gonna win. Okay, so there's another thing about winning that Dennis Waitley called the winning edge, and it's amazing. He said the horse that wins the race by a nose, how much better is he than the horse that lost by a nose? He's only a nose better, and yet he won. And the results of that win are huge. The difference in prize money, he probably makes 10 times more than the guy that came in second by a nose. He doesn't earn a nose more, he earns way more. His sponsorships and endorsements and all the other accolades that go with winning by a nose are huge compared to coming in second by a nose. I mean, his stud fees are 10 times more than the other guys, even though he just won by a nose. So that's the winning edge. A small difference makes a huge difference. And that's the same thing in investing. The winning edge, if you could be one of those few that's able to beat the market, yeah, and you don't have to beat it every day, you don't have to beat it on every trade, but over time, if you're a winner, the difference is huge. Let me give you an example. 100,000 invested over a 25-year period at different rates of return. Keep in mind that most investors are getting 4 to 8% returns on their money. Very few are getting in the 16, 20, 24% range, like my investors have been getting. So at 4%, 100,000 grows to 266,000 over 25 years. At 8%, it's 684,000. At 12%, it's 1.7 million. At 16%, it's $4 million. That's the winning edge. The difference between 684,000 and 4 million over time, by winning, by staying in the game, by understanding how winners play, studying the winners, following their strategies, developing your own, and winning. At 20%, 9 million. At 24%, $21 million. That's the winning edge. And we're playing this game to win, to not lose. That's not for everybody. Some people can't tolerate the nature of winning, which means sometimes you get hit in the face, sometimes you throw an interception, sometimes you lose a game, right? But we don't have to win every point to win the game. We don't have to win every game to win the set. We don't have to win every set to win the match. And by the way, even after this week, we're still winning. We're still winning on a 1 year, 3 year, 5 year, and year to date basis. And I expect we're going to keep winning because we're going to keep following the strategy of winners. So that's just my thought for today, to help those of you that might be struggling through this this one set of downs that we might be, looks like we're losing, but I believe we're winning the game. One of my favorite players, Ray Lewis, said to his went on the sidelines and to cheer his team up, he said, "Hey, put a smile on your face. This is a 60-minute ball game. So this game isn't over, and I expect us to win." So another beautiful day up in the hills. I'm heading off to the top of the mountain, and I hope you have a great day.